From the morning reading, despite all the hand-wringing about disappointing earnings, sliding commodities et al., the VIX Fear Index has actually declined the past 2 days along with the S&P. Even on the NASDAQ 100, its related gauge, the VXN, has barely budged, and it actually increased as the index was shooting to new highs. So over the past 4 days, the correlation between the index and VXN is highly positive, the third time that has happened in the past year. The others, late August 2014 and mid-November 2014, led to choppy upside for a few weeks, then swift, sharp declines. Overall, such displays of relatively complacency have been negative for stock returns, but it has not been a huge consistent edge. Also, the New York Stock Exchange advanced decline line weakens. Market breadth measures the degree of participation in a market uptrend. A rising market is stronger when most of the stocks are rising along with it. For example, only 44% of New York Stock Exchange stocks were trading above the 200-day moving average. That means that most big board stocks are in downtrends. Only 36% are trading above their 50-day line. The most traditional way to measure market breadth is with the New York Stock Exchange Advanced Decline Line. Let me show you one of those. The AD line is simply a running cumulative total of the New York Stock Exchange stocks advancing minus those declining. In a healthy market, the AD line should be rising along with both price indices. That's not happening. And this chart compares the New York Stock Exchange AD line, the red line, to the S&P 500 daily bars. Both have been rising together since last October. The red line peaked in April, however, and has been dropping since then, while the SPX is testing its old high. That negative divergence between the two means that the stock rally is being supported by fewer and fewer stocks. That's normally a caution sign and warns that the stock market isn't as strong as the popular stock indexes are suggesting. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:22 a.m. Central Time, and I am recording this in preparation for the market day of July the 23rd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive on into things. Let's quickly take a look at the charts themselves. Here's the S&P 500, and this has been really a classic example of what the candlesticks can tell you. Remember, we had the false breakout and then the quick sharp reverse, big bull, big bodied candle. Next candle also big body, but not quite as big as the prior one, and again not quite as big as the prior one. Starting to run out of energy, run out of strength, a little bit of indecision. We do get a good follow through candle here, taking us up back towards the prior swing highs. We break the prior swing highs, but look at what we do. We get a doji, spinning top, a bearish candle, and then full out pullback. This entire sequence here was easily forecast, and that you would run into some resistance here, both at this prior swing high and at the swing high nearby of the all-time highs. And remember, this right here came within only a couple points of the prior all-time intraday high. And then the bearish reversal with follow through, now confirmation of that. Now, so the question may be, well, where does this go from here? Well, at this point, when you look at the rest of the daily report, we'll get into that in just a second, we're not expecting a severe pullback, but that we would digest this huge move and have something of a retracement is not unexpected. Obviously, earnings is a big part of what's going on right now, and especially in the NDX. You've had the huge move in Google and then the huge pullback as a result of Apple. and this has created this kind of pattern in that one. Now that one has established all-time highs on the back of Google, but again, market breadth, and another example of very, very narrow market breadth being decidedly weak on the NASDAQ. You have on the Dow, of course, big component now of the Dow is Apple, and anytime you have one of the 30 stocks that does poorly, that is most definitely going to impact that average. But then when you have something like Apple, I mean, Apple is just huge in its market capitalization. It really does play on to the broader market. And then the Russell. And of course the Russell ran up against the backside of this channel line and definitely met resistance. We definitely foresaw that, and then it's now rolled back. So we now have a bit of a bullish candle coming in here, and the question becomes, you know, where next? So do we start to see this come back? And obviously we've got this lower low, lower high. You know, does this become something of a reversal of these recent trends, which, you know, while this was decidedly bullish in this ascending channel, this is broken down into a shorter term time frame of being in a bearish trend, and we need to get a reversal of that. And the best way to do that is for this to become a swing low. We'll continue to watch that. So on to our regular morning reports. Overnight action on the 4 broad market indices, you know, slightly positive, nothing to get excited about, only a couple 3 points in the S&P, but you know, it's still positive, and the Russell was up about 0.25%, so that was the most positive of the 4 at the time of the snapshot. Crude oil just barely positive. Euro nicely positive by about 0.75%. Bonds essentially scratch, and then our last one, and I see a little formatting error there, we'll have to get that fixed, and then the last one almost up 1% is gold. In terms of overseas action, Asia, China specifically up 2.4%, Hong Kong up about 0.5%, Japan about just under 0.5%, Germany essentially scratched but slightly positive, and United Kingdom up about 0.33%. So there's your Asia into Europe lead in. In terms of macroeconomic reports for today, very, very straightforward. We've got the weekly unemployment claims, nat gas, that's about it. Nothing on the slate for tomorrow other than the flash manufacturing PMI and home sales. So nothing terribly exciting in macroeconomic reports. Really, that's been the case all week. In terms of volatility, short-term VIX 11.2, skewed just below 125, so ebbed off just a little bit. IV percentiles 4, 5, 13, 21, all exceptionally low. We did have a standard deviation move put in yesterday by the NASDAQ. Obviously, this was driven by the Apple and the Microsoft earnings misses, and I say misses. Apple actually beat, but people have now come to expect that Apple will beat by a certain percentage, and if they don't, then that's the surprise. So it's just the game that goes on in the minds of traders around earnings, and you know, there's the analyst numbers, and then there's the traders' expectation of, you know, where you are with reference to the analyst numbers, and then, gosh, you better on your conference call not say something silly. So it's quite a little dance and quite a bit of volatility that can be brought on, and you have to sometimes scratch your head and say, well, they beat the revenue number, they beat the you know, the earnings per share number, and yet the stock is down. And why is that? Well, it's because expectations are what rule, and forward expectations rule all. So a little bit less than normal standard deviation moves being put in on the S&P. Normally expect 4, and the current 2-week snapshot only has 3. So we've had this kind of periodic pop and then ebb. This is especially true with recent range-bound activity and with the recent very low volume, kind of summer doldrum type of trading that we've been experiencing of late. In terms of a regular daily report, not a lot of change here from yesterday. Still phase 2 trend breaking. We're still looking for the establishment of that swing low to kind of set up for a trending market expectation. Obviously, we're smack in the middle of the recent range, but there is mostly positive. IBD status is in a confirmed uptrend. GMI index is 6 out of 6 with a buy signal. Stock charts has on trend model signals all 3 time frames is green. Investor term market posture is very bullish. Position sizing opinions both pegged at 100%. I mentioned this intermediate term market posture being very bullish. It has got some chinks in the armor, and that 2 of the 4 have now turned bearish, both the Dow and the Russell. But you know, the most important one to us is the S&P, and the S&P is still very bullish. As well, you need to kind of consider that you know, in terms of risk on, risk off, aggressive growth, and so forth, it's not like the components of the market that are super defensive have been growing, and indeed this doesn't seem to be terribly worrisome at this point, but certainly points for caution. Indeed, our overall hedge warning status remains a 0+, normal with cautionary aspects. And to break that down, you know, the various volatility metrics we look at all are in good shape. There is a high distribution day count. Indeed, we got a new one both in the S&P and NASDAQ yesterday. So this continues to be very problematic in recent weeks to months. Normally in healthy bull markets, you just don't see this kind of persistent high distribution day count. That skew right at 125 actually technically was just a rounding just below 125. This also concerning New York Stock Exchange new high, new low, continues to have very high counts on the new low. Yesterday was 515. Anything over 300 is a cause for concern. You can see we're well beyond that. Risk aversion indicators also deteriorated a little bit. We now have 2 as risk off and 3 as risk on. So not a super strong signal from there as well. Overall, our special opinions are all acceptable. Option income strategies, VIX inside the acceptable window, cover call, conditions acceptable with an opinion of 1-to-1 distribution between in the money and out of the money strikes. Put selling conditions are acceptable for new core put portfolio positions. Just kind of keep in mind position sizing and so forth with the overall range-bound activity. Sector market posture, you know, not terribly bullish here. Obviously, the pullback in the last couple days has deteriorated this indicator somewhat. But, you know, who's green across the board and who remains green across the board the most? Well, that'd be healthcare, consumer discretionary, and consumer staples. And of recent, we've seen financials putting in a bit of more consistency. Whereas who continues to seem to struggle? Materials and industrials and energy. Very, very poor bullish action still being put in by those sectors. Yesterday, as a percent change, you see financials, utilities, the 2 consumer, and healthcare. Well, no surprises, right? So, you know, if you're going to have any kind of bullish action, who do you expect it to come from? Well, many of these sectors specifically. If you are looking to see, you know, who's struggling the most, well, look at this. You know, energy, materials, you know, it's very consistent over time. If you learn to start following these patterns, you'll know where the money's going and where the money's not going, and where best to be looking for your watch list and other investment decisions. Well, I think that should be enough for today. As always, feedback is always welcome at support@falconglobaltraders.com. Retweeting, StockTwit, and YouTube liking, subscribing to the YouTube channel, all greatly appreciated and welcome. More information is available at this website. Disclaimers as always, hit the pause button if you need more time to review. and we'll look forward to seeing you back here for the market preview tomorrow morning. Good trading.